I'm rejoined by Jon Matchett from Lovell Blake Financial Planning. Welcome back, Jon.
Thanks, James.
How have you been? All right?
Yeah, good. Busy at the moment.
That's really good. And what we're talking about today is inheritance tax. So we're going to sort of focus on the basics and some common planning strategies and not go into too much of the really detailed points which we cover elsewhere. But this, I think, Jon, is one of the areas where the financial planning arm of Lovell Blake that you work for and the accounting and tax arm that I work for come together more frequently than in a number of other areas. And I think this is where, for those of you that don't know, not many accounting firms do have the financial planning arm, and Lovell Blake we do. And certainly when it comes to inheritance tax, I think that collaboration has become really important to our clients, hasn't it? And allows us to really get into the weeds of everything our clients need and help them in a joined up way.
Yeah, absolutely. I mean, we see a lot of clients who primarily invest money, so we see a lot of wealth. We also see a lot of clients who have their tax planning through you guys as well. So yeah, that absolutely does sort of cross over in quite a number of ways.
Yeah, absolutely. So I think the way to summarise inheritance tax and try and understand who it applies to and who should be thinking about it is to get an accountant and a financial planning advisor in here together, which is what we've done. So let's get into it a bit. So sort of strip it back and start at the beginning here. So inheritance tax typically is payable on the death of a UK taxpayer. Before we sort of go into too much more detail, I will just say that there are if you've got non-domiciled, non-resident individuals, inheritance tax can be more complex. And I've spoken to my colleague Sadie Nichols in the past, and she very much specialises in these areas. And so if anybody watching this is thinking about this from a non-resident, non-domiciled perspective, then get in touch with Sadie or watch one of the two discussions that we've had separately. But on a basic level, UK taxpayer passes away, inheritance tax is payable. What are the basics here, Jon? What's the tax rate and at what level is tax payable?
Yeah, so the basics are everybody has a £325,000 nil rate band allowance. So everybody generally has that. If you own a property and it's under £2 million and you have children or dependents you can leave it to, you can have an additional £175,000 allowance, which is called the residence nil rate band. So technically an individual can have a £500,000 allowance. For a couple, that can be doubled up, and if something happens to one and they are married or in civil partnership, it then basically passes to the second person on death. So effectively, you've got a double allowance on the second death, which is £1 million.
Yeah.
So anything over that £1 million, so if you have, say, £1.5 million worth of assets, effectively it's £500,000 that would then be charged at 40%, where you're looking at a £200,000 tax bill. So at the moment, those are the basics, and then there's sort of individual nuances as well. Yeah,
of course. Let's drill down into that a little bit. So unlike many other taxes, the 40% rate of inheritance tax, that is the standout rate. And there's, we'll come on to this shortly, where there is a sort of a half rate applied to certain transactions or certain assets, but ultimately 40% is the tax rate that you need to be aware of for inheritance tax. And what you said there, Jon, the nil rate band, so the first £325,000 of assets are exempt from inheritance tax, and you pay tax over that amount. And there's an additional residence nil rate band, which we'll touch on in a second. What sort of assets are taxed under inheritance tax? Because that's an important point as well, I think, because we talk all the time about, let's say, ISAs aren't taxed for income tax, whereas some other assets have capital gains tax on them. But for inheritance tax, which assets are core is quite simple, isn't it?
Yeah, absolutely. It's pretty much everything that you own. At the moment, though, it's not pension funds. So anything outside of a pension fund generally is classed as being in the inheritance tax calculation. One thing a lot of people forget as well is if you have a life insurance policy that isn't written in trust, and if something happens to you and that pays out, that can form part of your estate as well. So it's really important, if you do have any life insurance policies, to have a look and make sure they are written in trust where possible. So effectively they pay out of the estate and are not in the calculation. But yeah, effectively it's everything that isn't a pension fund. But the government are changing that, and obviously we can come on to that.
Yeah,
but
we'll touch on that
from
shortly.
next year, that will be included.
So we're talking properties, whether you live in them or whether they're second properties, whether you rent them out, investment
Yes.
properties. We're
Yeah.
talking amounts in bank accounts. We're talking about in
Yeah.
savings accounts. We're talking amounts in ISAs as well. ISAs get caught for HT, don't they?
Absolutely, they do. And one other thing is any gifts that you've made over £3,000 and it's outside of your normal net disposable income in the last 7 years, they come back into the estate potentially as well,
Yeah.
which some people do forget about.
Yeah, we'll come on to sort of the planning side of things, but that 7-year rule is an important one. So I think the starting point is every single asset from property to cars and jewellery and any cash deposits and investments, everything comes into the mix at this stage, and that forms your initial starting point. So £325,000 is the default nil rate band for each person. And then we talked about, or you mentioned, John, the residence nil rate band. So as you said, that's another £175,000, which most taxpayers can get.
Yep.
So that total £500,000 allowance that we're ending up with there, is that only against the value of your main home? If your main home is worth, say, $400,000, do you still get the $500,000, or is it limited to the value of your home?
Yeah, it's limited to the value of your home as well. So yeah, if for example, the home's less, then that would potentially be less. Yeah, you're absolutely right.
Yeah, so somebody might have more assets that pushes them over the $500,000, but
Yes.
ultimately that's restricted to the value of
Absolutely,
your home.
yeah.
And one or two other rules associated with this residence nil rate band is that if your total estate's over £2 million,
Yeah.
you do start to lose that additional 175,000. So be careful of those where you total up your assets and it exceeds 200,000.
Yeah.
And you mentioned that it has to be left in your will to a close relative. Is that right?
Yeah, it's generally there's a bit of a list, but it's generally if it's sort of sons, daughters, it can be stepchildren as well, sort of adopted daughter, sons. But yeah, it's sort of in that line of succession. It has to be left to you.
Yeah. Okay. Which is generally a pretty easy tick in the box to make, because that's where the family home would normally go. Yeah. And it has to be your own main residence. It can't be an investment property, second property, that kind of thing. Yeah, fine. John, you also mentioned about the rules around spouses, husband-wife arrangements, and that provides quite a lot of flexibility, I think, doesn't it? Both in terms of transferring the allowances and also transferring assets on death and not being caught by tax. Do you want to just talk us through those 2 points?
Yeah, so that I mean, is a key thing actually that again some people forget is generally if one person in a marriage or civil partnership dies, then the allowance will go to the other. But for that actually to be claimed on the second death, the administration or the people who deal with the administration on death of the estate have to actually claim that. That's not an automatic transfer. So they would do that via the form that you fill out for inheritance tax when someone passes away. So it's something to remember, because some people do forget that and then they lose that allowance, which can, if you're not claiming a 325,000 or 175,000, so 500,000 allowance, that's potentially £200,000 in tax that you might pay that you don't need to pay.
Yeah.
So it's just something to sort of make sure that you do claim.
Get your affairs in order and speak to your advisor. And I think typically when it comes to inheritance tax planning, as we deal with a lot of the time, you often find with a typical husband-wife arrangement, the tax is only ever payable on the second death. If you get a relatively simple will, what quite often happens is all the assets are left to the survivor, the second death, plus the allowances. So when we come to that second death, you may well have up to £1 million worth of allowances, as you mentioned earlier, and all the assets that couple owned. And then at that stage, we're looking at what goes to who in the will, full £1 million allowance, and then tax payable on any kind of excess. But again, whilst that is quite a straightforward will, the presence of a will in that arrangement is really important, isn't it?
Yeah, absolutely, because the will does say who you would like that to go to, and after a death, there can be people who think that they should be entitled to monies, and if the will isn't written properly, potentially you're looking at somebody contesting wills, and then you have to go through all the process of that and the legal side of it, which we have seen in the past. Yeah. So what is always a good idea is to make the will, to let the family know in some cases, what the situation is, who are the main beneficiaries, so there's no surprises. If somebody passes away and there's nobody who can then say, well, actually, I thought I was due this, and if you can get it all above board and all written and all settled while you're alive, that just makes it easier for who you leave behind.
Yeah, well, those mirror wills, as we call them, are important and very useful. But you're right, and quite often the emotive discussions come with what happens after the second death and who inherits what. And I think where I see the most concern amongst families is where much of the estate is held in property, in assets, and they're difficult to divide. And typically you'll have a family where adult children, some may live locally and want to make use of those assets. Some may live away, but ultimately it's difficult to divide up a piece of land or an investment property or a holiday home, and first pay the tax and also then split that down equally, because it involves asset sales, doesn't it?
Yeah, absolutely. And the tax bit is a key thing as well, is making sure that there's money available to pay that tax. Because a lot of people, again, don't realise that, once there's an estate, when somebody's passed away, and if it's a second death, the estate effectively locks up until probate happens, if that needs to be gone through. So the administrators have to find that money from somewhere, generally, to pay the tax bill to then release the estate. And often that's a problem in finding hundreds of thousands of pounds for somebody, especially nowadays with life being very expensive. People just don't have the availability of that money. So that's why proper inheritance tax planning and making sure money is available to administrators of the estate is also a key thing to look at.
We'll come on to some planning tips shortly, and I've got one or two, and I know you have as well, Jon. But before we do, let's just take us back to the budget, not last year, I think it was the year before, where there were some key announcements. The first Labour budget in the autumn of 2024. The first one I will just talk about, which is shares in trading businesses and farming assets, so farms, which have been very high profile in the news. It was announced that they were being brought into inheritance tax for the first time. Now, I'm not going to go into detail on this. We've done a separate podcast, and I'm more than happy to help anybody that wants to get in touch. But fundamentally, if you have shares in a trading business, probably your own business, or you are a farmer and have farming assets, then for the very first time, come April 2026, those assets will get caught for inheritance tax. Now, there is an increased threshold there, £2.5 million per taxpayer, and the 40% tax rate is reduced by half, down to an effective 20%. However, there is some effective planning that can be done around those, and refer back to my previous discussion, certainly with Ryan Lincoln on farms, and some of my earlier discussions around business shares. So that's an important change that really needs to be picked up by those that it's relevant to. The second one, which we are still about a year away from, and you did reference it earlier, Jon, is pension funds being brought into inheritance tax. And sort of not to put too fine a point on it, this is big news, isn't it?
It is. It's a big change. I mean, in the past, especially for a lot of companies that we deal with, we've looked at pensions as being a really good source of tax planning to get money out of the company and build up a retirement fund. But now we're seeing people with from doing this for years and years and years with £500,000, £1 million pots of pensions that primarily were never considered for inheritance tax purposes, because they were always thought of either being for retirement and something to produce an income in retirement, or if you didn't use it, to pass to family, because you can now pass pensions on to family, almost a little bit like a trust, like a legacy plan. Now these are going to fall into the estate from the 6th of April 2027. So all of a sudden, anybody who has existing planning that's up to date from April next year will have, potentially 500,000, £1 million, however much you've got, potentially another 40% to add to any, tax burdens. So we're looking at it now. I mean, it's at the moment, as far as we're aware, it's going to happen. I think it still has to be rubber stamped by and go into law. And we have seen sort of U-turns in the past with government announcements, etc. We don't know whether that might happen, but we have to assume that it won't. So this is a big sort of planning point for us to consider, and we are starting to talk to clients about it now, about sort of what the implications are and what we can do, to plan around there. I mean, ultimately, a pension fund, in the last 20 years, like I say, has been used to tax plan, but the ultimate point of that was to provide an income in retirement. So effectively, I think we're just reverting back to using that to provide an income in retirement rather than sort of for tax planning purposes.
Which was is the reason for pensions is to provide for your retirement and is not to pass wealth on. But of course, this is a big change. Anybody that was planning to pass on wealth to their beneficiaries in their will through a pension, this is big news. And I think what struck me when we spoke earlier is that if the taxpayer passes away aged over 75, there's effectively a double tax charge because the beneficiary then suffers income tax at their marginal rate when they actually draw the funds out. So imagine a pension 40% tax on death, and then your children, if they're paying tax at 45%, they will then pay that on the 60% that's left over, and before you know it, that pension is very little left.
Yeah, absolutely. And for us at the moment, it's just making clients aware, because there's been a lot on the news about sort of the farming and how farmers have been affected by the change in allowances. But there hasn't been a lot of press on this pension side of things. It seems to sort of pass under the radar, but it will eventually hit. And for certainly a lot of our clients, and certainly a lot of people around the country, all of a sudden you've got this tax burden. So what we're saying to people at the moment is, speak to your advisor about this. If it's something that's new to you, just, get in touch with a financial advisor or an accountant and have a discussion about how that would affect you. And also, whether you should be using that pension maybe to provide you with some income. It's another, I suppose it's an opportunity to look at your retirement plans as well.
Yeah, absolutely. Which brings us nicely on to the planning side of it. And certainly when I sit down with clients that talk about inheritance tax, one of the first things I will do is ask them to draw up a list of every asset and put a current valuation on it. And also debt, of course, if you've got a mortgage on a home or a second property, then that comes into the mix and reduces the value for inheritance tax. But for me, that's always the starting point, which is to have a look at all the assets you've got and the typical market values of those. And having a will in place is also important. A simple mirrored will, as we said, is absolutely vital. And also if it's a more complex arrangement, then we work with solicitors to bring in other measures. But I guess then the next thing we start to talk about is giving assets away, but it's not just as simple as giving something away and it's out of your estate, is it?
No. So, we say there's various forms of planning that, you can consider. The first thing, the easiest way, if you've got an inheritance tax liability, is to try and spend your way out of it. So buying things, though, is, you've got to consider that if you were to, say, take £100,000, if you had it in savings, buy a £100,000 car, you're just swapping an asset for cash, so you haven't really done anything. So what we're saying is, if you're going to make that international flight, and you've got an inheritance tax problem, maybe consider upgrading the flight, treating yourself a little bit more because, you're obviously then spending a bit more money. But spending, there's a hard way to get out of it, especially for people who are used to having a certain sort of frugal way of life. And we find a lot of people in late retirement have generally, all this wealth, and they just don't want to change what they're spending on. They don't want to sort of blow money on things that they haven't done in the past. But yeah, certainly gifting. I mean, at the moment, you've got a £3,000 annual gift allowance that each person can give away, and it comes out of the estate straight away. But if you've got a sizable liability, it doesn't really make too much difference, but it's certainly worth using. If you are planning from today and you haven't used last year's allowance, you can use last year's, so the 3,000 this year and last year, so that's 6, and per couple that's 12 straight away. You've also got potentially gifts out of disposable income as well, which not many people realise. So, for example, if you are lucky enough to have maybe £500 difference between your incomes and outgoings per month, you can actually gift that away, and that comes out of your estate as well. So spending and gifting are two of the sort of easiest ways out of inheritance tax.
And when it comes on to giving larger assets away, and ultimately the way I see this is just accelerating what the will will set out anyway. If you plan to leave your business shares or that investment property or that holiday home to your children in your will, then let's talk about whether we can do that now, so that inheritance tax isn't payable, and that is often where some of my discussions with clients tend to focus. And when it comes to that, the 7-year rule that you mentioned earlier kicks in. So give an asset away today, and it effectively is still clawed back into your estate for up to 7 years. You have to survive 7 years for that to fall away, but that's not 100% at year 7, is it? There's a tapered basis on that. Yeah,
so from year 4, there's a tapered basis on what the actual tax payable is. What you can do is, so if you consider that if you gift money away, If you survive for 7 years, it comes out of the estate. If you die within that, potentially there's some tax liability. An easy way around that is you can speak to a financial advisor and we can set you up with a life insurance policy that covers the 7 years. And all that would do is, if there is a liability of something, if you say, for example, pass away at year 6 and there's some liability, the life policy just pays out a lump sum to the executors who can then pay that tax bill. So it's an easy way to sort of make sure that if you are giving money away, that, just in case you don't survive the 7 years, that the liability is taken care of.
Yeah, fantastic. I want to mention life policies in a second. I was just going to, one final point when it comes to giving assets away is there's also a clawback if you continue to benefit from that asset. So the typical example is the family holiday home. You give that away to your children, but then you still holiday there every summer. And at that point in time, the gift is not effective. You should be paying a market rate of rent or stop using it. And this is often... the number of people I've sat with who have said, well, I'll just give my home away to my children. And then in 7 years' time, we'll be free of inheritance tax. And actually, it's very difficult. And I've not actually seen it achieved where logistically a couple can give their home away, continue to live in it, and it to be an effective inheritance tax gift. Yes, that paying rent on your own home and everything that goes with it is very emotive. So that gift with reservation clawback is important. You mentioned life insurance policies, and I think this is an area that, for me, people assume they're very expensive, especially as you get into later life and you are starting to plan towards sort of inheritance tax, which is, past your 50th birthday is where most people start to think about these things. But actually, I was speaking to your colleague Scott recently, and some of the prices for life insurance policies are a lot cheaper than you might think, aren't they?
Absolutely, yeah. I mean, that's a key way to actually sort an inheritance tax problem quite easily without having to worry about gifts or giving away any of your personal belongings or money, is to simply find out what the liability is for inheritance tax. So, for example, let's say it's a couple $100,000, setting up what we call a whole of life policy to pay out. So the tax bill is paid from the proceeds of that policy. It's paid into trust. And some of the premiums, you could be looking at a couple £100 a month maybe for something like that, but that would save a couple £100,000 in inheritance tax. And often what we do when we're looking at planning, we'll work out for clients, right, this is your liability. So let's say £200,000. Here's a life policy, but if you were to survive to, let's say, a sensible age, for life expectancy, this is the premiums you'd pay. And often, you might end up paying 20,000, 30,000 premiums, but you're saving £200,000 in inheritance tax bill. So it can work out financially better. Sometimes when people see a sort of a monthly amount of a couple of £100 a month going out and they think, well, actually, what am I getting from it? It's hard to see that value initially, but, we do see, unfortunately, the other side when somebody does pass away and we're dealing with the estate. And actually that policy can make such a difference to, the family. And often, again, people have spare income. You can use the spare income to actually pay the premiums. So you don't really notice it, but you know that there's a plan there for your future generations that you're passing money to, that they don't have to pay hundreds of thousands to HMRC. Yeah,
and you mentioned earlier, John, that best practice is to have these life policies built into trust. And what that means in simple terms is that if you didn't build a life insurance policy into trust, that would pay out into your estate and would add to the value of your estate, and tax would be payable on the payout, wouldn't it?
Yeah, that's it. And the trust it, it's a simple form. You'd set it up with, who the beneficiaries are and what percentage, is to go to whoever, or who will pay the tax bill, pay it to them. It's just a form and a few signatures, and that can save tens and hundreds of £1,000s worth of tax.
But it also speeds up the payout, doesn't it?
It does. It does. Yeah. It's literally just a case. You notify the life insurance company that somebody's passed. Often you send a sort of death certificate and proof of who's dealing with the estate, and they can pay the money within weeks. And then you pay the tax bill, and then it's released, and then deal with all that comes after that.
And the use of trusts in general terms is something that many people find quite useful, and that's a specialist area, and we're not going to go into it in too much detail now. But put simply, I always see a trust as almost like a holding pen, a parking space for those assets. If you want to get some assets out of your estate, but you don't want to pass them on to the beneficiaries at this moment in time, you can set a trust up, gift into the trust, the 7-year clock starts ticking, or various other rules apply for different types of trusts. And then those assets are effectively distributed to the beneficiaries at the right time. Do you see the use of trusts quite common these days, or is it relatively rare?
We do where parents don't want to quite give their money to children yet for whatever reasons, whether it be that they might be having marriage difficulties and they worry about if they pay money to a child that a divorce or separation could then mean that some of that money goes to somebody else, or they're worried about whether the child is going to just fritter the money away as such. You can pay it into a trust, and it's a way of gifting it away from yourself, but not quite getting to the receiver. So it's an in-between space. But while it's in that in-between space, the gifter, or the settlor we call it, the person who's gifting it into the trust, has full control over it. So they can decide how it's invested when it's paid to the beneficiaries by the type of trust you set up. So it gives people some control as opposed to just handing over a property or money blindly and then not being able to do anything with it during their lifetime. Yeah. So there's certainly a place for trusts.
Yeah, absolutely. And I think we keep coming back to the point, which is to engage with the family. This is an area where many clients, they don't want to face up to the fact that there is tax payable. And for some, they have the attitude that, I won't be here when this tax is payable, and therefore, my beneficiaries can deal with it. But I think for many, this is a very sensible discussion to have with your spouse and also with anyone named in your will as to how those assets are going to be distributed and what you can do about inheritance tax. And I've heard inheritance tax described many times in the past as an optional tax. And ultimately, that is the case because if you are prepared to give things away and you are prepared to set up policies, as you've said, to cover the tax itself, then it shouldn't impact your family. But early planning is important, and I think that's probably the takeaway from my point of view, isn't it?
Yeah, absolutely. I mean, the first thing that I do say to a lot of clients who have an inheritance tax problem, and just sort of to lighten the mood in the initial conversations, is you do know this is voluntary, don't you? And there's sort of that look of shock, and it's we then follow up by saying, it's voluntary because if you plan around it, you can do something about it, whereas if you don't, then you'll pay the tax. So it's definitely worth, I think if you've got an estate that you think is liable to inheritance tax, speaking to professionals and just seeing what the options are, even if you just, look at it and realise, well, that's my liability, okay, I'm just going to go and spend more to try and get my way out of it. But often we do recommend that sort of families get involved because it is a generational process. So eventually the family will receive it. And if we get the families involved in the early stage planning, it's not a surprise to them when all of a sudden all this money comes to them and then all this paperwork. So we can sort of set that up front and then there's no surprise for anybody.
Yeah, absolutely. Here, I would say, Jon, I agree with everything you just said then. And from our point of view, as I said, at Lovell Blake, we work closely together, and we've got that luxury of having the financial planning and the accounting and tax side of things, so we really can cover every base. We work closely with local solicitors on the will drafting, that kind of thing. So it's just a matter of getting in touch with us, having an initial discussion, as I say, what does the current exposure look like? And if that's a number that scares you, then we can do some planning around it.
Absolutely.
The earlier, the better. Yeah. Okay, well, thank you for your time today, Jon. And thanks, anybody out there that wants to get in touch with Jon, his details are on our website, as are mine. But for the time being, until we meet again, thanks for joining us. See you next time.